Hey everybody, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis Live. As always, we write a lot about the crypto markets and we put it all on our blog at ar.ca/blog. And we then come on here and talk about what we wrote. So before we begin here, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. So we're probably going to keep it nice and short and sweet this week because it's pretty easy to summarize what happened last week. Basically, macro doesn't matter anymore, and Washington does. And of course, I'll get some flack for that. Macro always matters a little bit. But what I'm trying to get out of that is that a year ago, macro was the only thing that mattered. From November 2021 to April 2022, it didn't really matter what you were invested in. What mattered was what was happening with the pace of rate hikes. We started the year with expectations of 3 hikes of 25 basis points each, and obviously we instead got a string of 4 hikes of 75 basis points each, which is just now being tapered off a little bit. So really, the first, those 5 to 6 months from the end of 2021 to April 2022 is all that mattered, was what was happening with rates, what was happening with the Fed, how global liquidity was being pulled, and that trickled down through the bond market, through the equity market, through real estate, and obviously to digital assets as well. Well, the reason I'm bringing that up is that last week there was a packed economic calendar. So if you were still stuck in late 2021, early 2022 mode, you didn't do a whole lot of investing because you were nervous. We were looking at Chicago PMI, China PMI. You had GDP coming out of Canada. You had the FOMC meeting. You had the B of E, the Bank of England, and the ECB, as well as obviously on Friday, the non-farm payroll report. And on top of that, you had massive tech earnings, right? Most notably from Apple and Google. So it was a big slate on the economic calendar last week, and it didn't matter. Pretty much every single one of those events came and went. I'd say the biggest reaction probably came on Friday when you had a really hot NFP report, the non-farm payrolls, which is certainly scaring investors into thinking maybe we're going to have more prolonged rate hikes. But other than that, a little bit of sell-off on Friday. I mean, it was overall a pretty good week for risk. The tech earnings were mixed. The economic didn't matter a whole lot. And basically what you're looking at here is a more similar environment to, call it 2019 and maybe even 2020 pre-COVID, which was the market's going to trade on the merits of the individual components and not just student body left, student body right. And, I think in retrospect, this was pretty obvious, right? I mean, the problem with what the Fed did, the problem with going with a string of 75 basis point hikes last year was that no matter what the economic data said, no matter what was going on in the economy, at some point they were going to have to slow down, right? You weren't going to be able to raise rates at 75 basis points per meeting in perpetuity. And no matter what, as soon as you start to slow it down, no matter how much you talk, no matter what you say, once that rate of change slows, the markets are going to resume their animal spirits. And they're going to start buying and start front running what is the inevitability of this rate hike cycle coming to an end. So in my opinion, that chapter is over. If you're still sticking to a purely macro playbook, it's time to start looking at a more fundamental playbook instead. 2-3 years ago, I barely even logged into my Bloomberg. Not just because the CRYP page on Bloomberg is pretty irrelevant, which it still is, but just because that stuff didn't really matter, right? Digital assets were moving based on technology, based on software upgrades, based on new tokens coming out, based on new themes and sectors. So really the last, called that 6 to 9 month stretch where we were driven entirely by macro, that was the anomaly, not right now, right? The norm for digital asset investing is looking at token unlocks, looking at the different issuer types, looking at the different sectors, the themes, the structures, any nuances that come with these different tokens. And I think we're going to be back in that environment for all of 2023. So, not to be too hyperbolic, I'm not to say that macro doesn't matter at all. Of course, macro still matters, right? What the dollar is doing, the dollar weakening, always good for risk assets. Lower rates is always good for risk assets. There's always going to be a component of what we see in macro land that's going to impact the digital asset space. But I think investors are going to have to start being a little less binary, right? It's no longer low rates and low growth. Low growth is good for speculative assets, whereas high rates and high inflation is bad. There's going to be a lot more nuance in here, and there's a very good chance that we don't get a really deep recession or even really a soft landing. There's a good chance that 2023 we just sort of hum along, right? As long as employment stays where it is, and the Fed kind of takes their foot a little bit off the gas here, this is going to be much more of an alpha market than it is going to be a beta market. And I thought it was really interesting talking to our friends at Cumberland over the weekend, who trades quite a bit of tokens and stable coins, both OTC as well as on the exchanges. They pointed out in one of their notes to us that really thematic investing is back with all their clients. You look at things like Optimism, which traded above $3 this weekend, which is up over 200% for the year, or things like Render up 300%, or DYDX up 200%, or Lido up 100%. In all of these cases, they noted that they traded more volume OTC already in the first 5 weeks of this year than they did in the entire second half of last year. And again, these tokens I just mentioned, they're just a couple of many that are out there. But these are all things that had real defined catalysts, right? There was real idiosyncratic drivers of price gains. And it had nothing to do with sort of the overall macro picture. So we're looking for more of that to come. Certainly encouraged by the price action last week, as well as really all of this year. And we'll see if anything throws a wrinkle at us. I'm sure it will. That's how markets work, right? When you don't expect anything to come, that's when something new comes. But for now, it does look like it's a pretty good environment for investing, and certainly those projects that have real cash flows, real tokenomics, and potentially real partnerships and news coming are probably the ones who are going to be the beneficiaries of that. So moving on, I said at the beginning, macro really doesn't matter anymore, but Washington does, and I think that's that's something that is going to be a prevailing overhang really for the entire year here, right? We know the events at the end of last year with FTX has certainly caused a stir in Washington. I didn't realize, but I saw this the other day from CoinDesk, that 1 in 3 members of Congress got cash from FTX or some affiliate of FTX. That's pretty incredible. That's like nothing I've ever seen, to see one company really trying to control all of Washington like that. But what's interesting is, instead of giving the money back, I mean, a few senators and congressmen have given some of the money back, but for the most part, they haven't given the money back. They haven't donated it. And instead, they're kind of just sitting back and watching as the regulators are making a lot of noise. And as we all know, by the time this actually reaches Congress and you have new laws enacted, it's going to be some time. But in the meantime, you have a lot coming out of different areas of Washington, right? So, for instance, last week alone, the Federal Reserve released a policy statement which further limited digital asset activities by member banks. A couple weeks earlier, we had the Office of the Comptroller of the Currency, the OCC, as well as the FDIC, along with the Federal Reserve. They issued a joint statement questioning the safety and soundness of digital assets. Meanwhile, the SEC continues to be on the warpath. In essence, what they're really saying is, we don't have the rules in place to regulate this industry correctly. So what are we going to do instead? We're going to take those players that we can regulate, the banks, the brokerages, and we're going to basically limit their involvement, which is really not great, right? I mean, this is a stopgap solution that really doesn't solve a whole lot. What we want to see is a path forward. We want to see some positive change here in terms of how do we get to an industry that has some clarified rules in place and allows mass entry from banks and brokerages and companies and projects around the world. But instead, we're going to get more restrictive, right? And I think that's sort of, I wouldn't go so far as to say it's meant to crush this industry, because I don't think that can happen, first of all. And I also don't think that's really the goal. But it's certainly meant to limit the participation, which means that what we're looking at today with the players, your large OTC brokers, your large exchanges, the tokens that exist today, that might be the crop that we're looking at for the next 12 to 18 months. Like, there's really going to be a very high barrier to entry in terms of new businesses getting into this market right now, because of these policies that are being in place by the regulators. And that's not great, right? Again, we want to see some innovation, right? I want to see Netflix issue a token. I want to see Disney issue a token. I want to see Harvard and NYU and Stanford issue a token. I want to see New York City and Miami and Los Angeles issue tokens. And we're just not going to get that while most of the non-digital asset native companies are being shut out of this market. On the positive side, though, I would say that Hester Peirce, one of the SEC commissioners, who obviously has more of a liberal spin, did come out again with another great speech a couple weeks ago, talking about where the SEC and other regulators can start to make some progress. And I think it's worth, we linked to to the full speech in our blog, and we also annotated a little bit. Excuse me. Excuse me. We linked to it in our blog, and we annotated it a little bit as well, and really pointed out what we think is the most important parts. Excuse me. I guess I'm under attack for mentioning the SEC. We annotated what we thought was really the most important segments of what she's saying. And I think most importantly is, Hester Peirce was talking about that you can't really wait for regulators to fix all the problems, right? Some of these things have to happen on their own organically. And, I think there's a lot of areas in the digital asset space, a lot of bigger companies, a lot of lobbying efforts that are trying to do just that. And it's a refreshing take that the regulators understand that sitting around and just waiting for regulators to do something is not optimal, right? You do have to push the envelope. You do have to, have individuals and companies fighting to push that envelope while we wait for better regulation. The other point is that I thought was really interesting was acknowledgement from Commissioner Peirce that this is not easy, right? The SEC is not just Gary Gensler and his public campaign to get to further his political career in Washington. There's thousands of staffers at the SEC, at the CFTC, at other regulatory bodies that really understand this space and are really doing their homework and their due diligence and trying to understand how digital assets really differ from stocks and bonds and other regulated instruments. Recognizing that there's nothing illegal about being a security. In my opinion, you can call them all security if you want. It matters to me as an investor or a user. It matters to the exchanges that list them. It matters to the companies who issue them. But for those who are just buying and selling and utilizing blockchain, it doesn't matter at all whether you're a security or not. So, in my opinion, I would love to see the SEC and other regulators, call it all security. Feel free to own the whole space, regulate it. But when you do, lower the barriers and costs of registration, grandfather all the existing DEXs and exchanges as they work to get licensed, and allow for ICOs and other fast and easy sale and distribution mechanisms, right? If the SEC wants to own this space, by all means, own it, call it all security, go for it. But there's no reason that just because we do that, we have to mimic existing Wall Street rules that have not adapted to this new technology and to changing investor habits. So I think ultimately it's refreshing at least to see somebody out there at a governing regulatory body like the SEC who understands and has these views. It's obviously frustrating that collectively they're trying to stymie innovation right now and sort of keep this industry in its pocket just long enough to try to get the rules right. But in the meantime, what it's likely to do is it's going to make the rich get richer, right? You look at already Binance has 70% market share, Uniswap. Or Binance has 70% market share of total centralized spot and futures trading, right? Uniswap has a 70% market share of decentralized spot trading. DYDX has a 70% market share of decentralized derivative trading, right? With no barriers to entry, with high barriers to entry now and no real newcomers coming in, that's unlikely to change very much. So I think you're going to start to see some monopolistic problems pop up here because of these governing bodies basically limiting anybody else from getting into this space. So we'll see what that means for market prices. I think it means we're going to have a smaller pool of assets to invest in, and it probably means as new money comes in and there's less places to go with that money, it probably means prices rise. So we'll see if that plays out throughout the rest of the year. We'll see if other people like Commissioner Peirce kind of speak out against this more draconian regulatory approach. And we'll see what that means for the market. But at least for right now, between the volumes increasing, between macro really not driving the bus anymore, certainly feels pretty constructive for asset prices. So that's it for this week. I encourage you to check out the blog. Again, you can find it on our website, ar.ca/blog. A lot of helpful charts and information in there. And we'll be back again next week. Thanks, everybody.